Picture this. Two traders, same strategy, same capital, same market conditions. One turns $30,000 into 80 million. The other blows up 3 accounts and quits forever. If that scenario hits close to home, then welcome back to Trading Psychology Stick. This isn't just a channel, it's a training ground for the only market that truly matters, the one between your ears. And let's be crystal clear before we proceed. This is not financial advice. My purpose isn't to give you hot stock tips or a magic indicator. My purpose is to dissect the operator, you. Because mastering your own psychology is the only edge that can't be arbitraged away. So, what did make the difference? Not their system, not their timing, not their luck, but a trade they both made before they ever opened a chart. A trade with no ticker symbol, no entry or exit, just a silent decision that determined everything that followed. Richard Dennis proved this with his Turtle Traders experiment. He took 23 people with zero trading experience, an actor, a security guard, a blackjack dealer, and taught them his exact system. Same rules, same capital, same mentor. The results? Some made millions. Others lost everything. The difference wasn't in what they learned. It was in who they chose to become. Every click of your mouse, every position you take, every rule you break, you're not actually trading the market. You're trading the story you tell yourself about who you are. And that story, it's either your edge or your execution. Here's what Jack Schwager discovered after interviewing dozens of market wizards. The ones who survived didn't have better strategies. They had better relationships with themselves. They made a different trade, an invisible one. The trade where you decide, am I going to master the market or master myself first? Because at 2 a.m., when you're staring at a massive loss, when your system says exit but your ego screams hold, when everything inside you wants to double down and chase, that's when you discover which trade you really made. Let me tell you what happened to someone who thought he was different. His name was Nick Leeson, brilliant, authorized to make trading decisions for Barings Bank. Had every advantage, lost $1.3 billion, not because he couldn't read the market, but because he couldn't read himself. The market didn't destroy Barings Bank. Nick's inability to take a loss did. This isn't another guide about setups or indicators. This is about the battle no one talks about, the one that happens between your ears, the one that determines whether you'll join the 95% who fail or the 5% who transform. Every market wizard made this invisible trade early. Paul Tudor Jones, Ed Seykota, Michael Marcus. They all chose to face one uncomfortable truth. In trading, your biggest position is always in yourself. And right now, in this moment, you're about to make that same trade. The question is, will you even realize you're making it? Section 1. The most important trade you'll ever make. Right now, pull up your transaction history. Count every trade you've ever made, hundreds, thousands. Now, let me tell you something that'll twist your mind. None of those were your most important trade. That one happened before you ever funded your account. It happens every morning when you wake up. It's happening right now as you watch this. It's the trade you make with yourself about who you're going to be when the pressure hits. Michael Marcus learned this the hard way. Started with $700, blew it, borrowed more, blew that too. 7 times. 7. But on the 8th attempt, something shifted. Not his strategy, his identity. He stopped trying to prove he was smart and started trying to prove he could follow rules. That invisible shift, it turned him into a trader who transformed $30,000 into 80 million. Think about your last losing streak. What story did you tell yourself? The market's rigged, my system stopped working, I need a better strategy. Those aren't observations, they're identity statements. You're not describing the market, you're describing your relationship with discomfort. Here's what separates the 5% from everyone else. They understand that every chart is actually a Rorschach test. 2 traders see the same pattern. One sees opportunity and waits for confirmation. The other sees validation for their need to be right and jumps in early. Same chart, different stories, drastically different outcomes. Picture yourself tomorrow at 9:30 a.m. Market opens. Your setup appears. But it's not perfect. Maybe 80% there. What happens next reveals everything. Do you take it because you're afraid of missing out? Do you skip it because it's not ideal? Or do you take it with reduced size because that's what your rules say? That decision, that fraction of a second, that's the real trade. and it's already determined by the contract you've made with yourself about who you are as a trader. Linda Rashka put it perfectly. The best traders have evolved to the point where they trust their methodology and themselves. But here's what she didn't say. That trust isn't built in winning trades. It's built in the moments when you follow your rules despite wanting to break them. Every single time you honor your stop loss, when your gut says just a little more room, you're making the invisible trade. Take this test. For 1 week before every trade, write one sentence. Am I trading the setup, or am I trading my need to fill in the blank? Need to be right, need to make money, need to feel smart, need to recover losses. Be ruthlessly honest. After 20 trades, you'll see the pattern. Not in the market, in yourself. The market doesn't care about your mortgage, your ego, your dreams. It only reflects one thing with perfect clarity: your ability to execute without emotional distortion. Master that trade, the one with yourself, and everything else becomes just process. But if that's true, why do brilliant traders with proven systems still fail? The answer reveals everything wrong with how we think about trading systems. Section 2. The myth of the Holy Grail. I'm about to destroy your favorite excuse. You know the one. It whispers to you after every losing day. If only I had the right system. Stop. Ed Seykota turned $5,000 into $15 million using moving averages. Basic. Boring. Something you'd find in a Trading 101 textbook. Meanwhile, traders with AI algorithms and 17 monitors are bleeding capital daily. Explain that. The turtle traders experiment shattered the system myth forever. Richard Dennis gave 23 novices his exact rules, not hints, not concepts. The precise system that made him hundreds of millions. Same teacher, same technique, same capital. The results? Some became millionaires. Others washed out completely. If systems were the answer, they'd all be rich. But systems are just tools, and tools don't fail. The hands holding them do. What perfect system are you secretly hunting right now? Drop it below. No judgment. I spent 3 years chasing the Holy Grail too. Here's the uncomfortable truth. The profitability isn't in the system. It's in your ability to execute it without deviation. Tom Basso proved this. They called him Mr. Serenity. His trend-following system was so simple, a child could trade it. But Tom had something rare. Total emotional flatness. He didn't get excited by wins. Wasn't destroyed by losses. He followed signals like a machine. That temperament, not his system, made him a market wizard. Now picture the opposite. Victor Niederhofer, genius-level intellect, Harvard PhD, George Soros's right-hand man. Built complex statistical models, made fortunes, lost everything, rebuilt, lost again. His systems were brilliant. His execution was poisoned by the need to be the smartest guy in the room. Systems fail for one reason. Humans can't stop touching them. You backtest a strategy. It shows 65% wins. You go live. 3 losses in a row. Suddenly, that proven system needs tweaking. You add a filter, change a parameter, adjust the stop. Each modification feels logical, but you're not optimizing. You're avoiding the discomfort of being wrong. Markets breathe. They expand and contract, trend and chop. A system that prints money and volatility might bleed in consolidation. The market wizards understood this. They didn't chase perfection, they mastered adaptation. More importantly, they mastered the patience to let systems work through their natural cycles. Here's your reality check. Whatever system you're using right now is probably good enough. The question is, are you good enough for your system? Can you follow it when it's painful? Can you trust it through drawdowns? Can you resist improving it every time you lose? The 95% keep searching for better systems. The 5% keep improving their ability to execute the one they have. One group stays broke, the other gets rich. The difference isn't in what they trade, it's in who they become while trading it. But understanding this creates a new problem. If success requires accepting losses, how do you know when you're losing because of probability, or because your edge never existed? That's where the math gets interesting. Walk into any casino, watch the dealers. They lose hands all night long. Big hands, painful hands. But notice their faces, completely neutral. They don't celebrate wins, don't mourn losses. They know something the gamblers don't. Individual outcomes are meaningless. Only the math matters. Now, watch yourself trade. Your stomach knots when a position goes red. Your heart races on big wins. You replay losses obsessively. You're not thinking like the house, you're thinking like the mark. And that emotional attachment to individual trades, it's costing you everything. Mark Douglas taught this to thousands. There is a random distribution between wins and losses for any given set of variables that define an edge. Read that again. Random distribution. Your next trade might lose even if your edge is rock solid. Your next 10 trades might lose. The edge only appears over samples, dozens, hundreds of trades. Monroe Trout lived this philosophy, one of Schwager's most statistically minded wizards. His approach was pure math. I don't care about being right on any single trade. I care about executing thousands of trades where probability favors me. Result? He averaged 70% annual returns for over a decade, not by predicting, by playing probabilities. Think about coin flips. If I flip heads 7 times straight, what are the odds on flip 8? Still 50%. But your brain doesn't work that way. It sees patterns in randomness, assigns meaning to chaos. In trading, this delusion is expensive. Here's what probability really looks like in trading. You have a setup with 60% win rate, 1.2 risk reward, solid edge. But those wins won't distribute evenly. You might see win-win, loss-loss, loss-loss, win-win, win-win, same edge. Wild emotional swings. The amateur changes strategy after the 4 losses. The professional knows it's just math being math. Watch what happens in your mind during a losing streak. Trade 1 loses, mild annoyance. Trade 2 loses, frustration building. Trade 3 loses, doubt creeping in. Trade 4 loses, this system is broken. By trade 5, you're either paralyzed or revenge trading. Not because your edge failed, because you failed to think in probabilities. The market wizards internalized something crucial. You can't control outcomes. You can only control 2 things, your edge and your execution. Everything else is noise. Larry Hite put it brilliantly. I don't trade markets. I trade math. When you truly understand this, individual losses stop mattering. Only the process counts. Try this exercise. Take your next 20 trades. Before entering, rate your emotional need for this specific trade to work. Scale of 1 to 10. Track the results. You'll discover something disturbing. The more you need a trade to work, the worse you execute. The attachment corrupts the process. Casinos don't sweat individual players winning. They know the math ensures their edge over time. Your trading should work the same way. Clean setup, take it. Follows your rules, execute, hits the stop, next trade. No stories, no emotions, just probabilities playing out. But accepting randomness is only half the battle. You still need an actual edge. How do you build one that's truly yours? Not borrowed, not copied, but forged from your own trading DNA. Stop looking for edges in trading forums. Stop buying systems from gurus. Stop copying someone else's setup and wondering why it doesn't work for you. An edge isn't discovered. It's forged in the fire of your own experience, with your own scars, through your own lens. Michael Marcus didn't find his edge in a book. He built it by losing everything 7 times. Each blow-up taught him something about himself, his weakness for averaging down, his tendency to overtrade, his emotional attachment to being right. By the 8th attempt, he'd forged an edge from his failures. Trade small when uncertain, big when confident, simple, personal, devastating, effective for him. An edge is just this, a repeatable behavior that tilts probability in your favor, not magic, not secret knowledge, just a slight statistical advantage executed consistently. But here's what nobody tells you. The best edges are boring, mind-numbingly boring. They should feel like brushing your teeth. William O'Neill spent decades perfecting CAN-SLIM. 7 variables. That's it. While others chased complexity, he refined simplicity. His edge wasn't in finding new patterns. It was in recognizing the same pattern thousands of times until he could spot it instantly. Depth, not breadth. Look at your last 50 trades. Where did you make money consistently? What conditions? What setups? That's your edge trying to reveal itself. Share your discovery below. The 95% think building an edge means adding more indicators, more rules, more complexity. But the 5% understand it's about subtraction. Strip away everything that doesn't directly contribute to your probability advantage. What remains is your edge. Here's how to forge yours. Document everything, every trade, every emotion, every market condition. After 100 trades, patterns emerge, not in the market, in you. Maybe you nail opening range breakouts but butcher reversals. Maybe you're deadly in trending markets but lose in chop. Maybe your win rate doubles when you trade only the first 2 hours. These patterns are your raw material. Now refine them. If you excel at breakouts, become a breakout specialist. Study every nuance. What time of day works best? Which instruments? What volume patterns? Build depth, not variety. Bruce Kovner said it best. The first rule of trading is, don't get caught in a situation where you can lose a great deal of money for reasons you don't understand. But here's the crucial part. Your edge must match your psychology. If you're impatient, swing trading will torture you. If you hate staring at screens, scalping will burn you out. The most profitable edge is worthless if you can't execute it consistently, and you can't execute what goes against your nature. Jim Rogers traveled the world. His edge? Global macro understanding from first-hand observation. George Soros broke the Bank of England. His edge? Understanding reflexivity in markets. Different traders, different edges, both wildly successful, because they traded their strengths, not someone else's system. Your edge is hiding in plain sight. In the trades you take naturally, in the setups that feel obvious to you but invisible to others, in the patterns your unique brain recognizes effortlessly. Stop trying to trade like someone else. Start refining what already works for you. But even the sharpest edge is worthless if you destroy yourself at the first sign of adversity. Which brings us to trading's darkest truth. Victor Niederhofer, Harvard PhD, champion squash player. George Soros' hand-picked trader, made millions, lost everything, twice. His intelligence was never in question. His discipline was. Because in trading, IQ means nothing when emotions hijack your execution. The destruction pattern is always the same. First comes success, then confidence, then a loss that challenges your identity, then the spiral. You don't just lose money, you lose yourself. And in trying to get back to who you were, you destroy who you could become. Ever broken your own rules after a losing streak? Type guilty. If you've been there, you're not alone. Even market wizards have blown up. Nick Leeson didn't plan to destroy Barings Bank. He was trying to hide a small loss. One unauthorized trade to fix a mistake, then another, then another. Each violation made sense in the moment. Each was justified by the pain of admitting failure. By the time he stopped, he'd lost $1.3 billion. The bank collapsed, all because he couldn't accept a $20,000 loss. Here's what actually happens in your brain during a losing streak. Cortisol floods your system. Your prefrontal cortex, the rational planning center, goes offline. Your amygdala, the fear center, takes control. You're literally not the same person. The calm trader who wrote those rules, gone, replaced by a frightened animal trying to escape pain. Jesse Livermore understood this, made and lost fortunes multiple times. His greatest insight wasn't about markets, it was about himself. The human side of every person is the greatest enemy of the average investor or speculator. He knew his patterns. When he followed rules, he made millions. When emotion took over, he gave it all back. The spiral always follows the same sequence. Loss challenges your identity. I'm supposed to be good at this. Ego demands you prove yourself. I'll show the market who's boss. Rules get bent, then broken, just this once. Position, sizes increase, need to make it back faster. Stops get ignored, it has to turn around. Account implodes. How did this happen? Let's pause. This is heavy stuff. Even Paul Tudor Jones admitted to crying after losses early in his career. You're human. That's not weakness. It's reality. The question is, what do you do with that humanity? The solution isn't to become emotionless. You're not a robot. The solution is to build circuit breakers for your humanity. Richard Dennis had a rule. After 3 consecutive losses, cut position size in half. Not because the system was broken, because he knew his psychology might be. Create your own safeguards. Hard daily loss limits. When hit, screens off. Mandatory cooling periods after big losses. Position size rules that account for emotional state. A buddy system for accountability. The smartest traders aren't the ones who never fail. They're the ones who fail fast, small, and forward. They recognize the spiral early and have systems to break it because they know something the 95% don't. In trading, protecting yourself from yourself is the highest form of risk management. But if we're all vulnerable to these spirals, how do some traders develop an almost supernatural ability to stay calm in chaos? The answer changes everything. Section 6. Risk management is risk acceptance. Here's the most expensive lie in trading. I can manage risk. No, you can't manage risk any more than you can manage gravity. Risk simply exists. What you can manage is your exposure to catastrophe. The market wizards understood this distinction, and it made them unstoppable. Bruce Kovner nearly destroyed himself on his first trade. Soybean futures, massive position, no stop loss. Watch profit swing to near total loss. The experience was so traumatic, he almost quit. But that terror taught him something priceless. Risk management is the most important thing to be well understood. Undertrade, undertrade, undertrade is my second piece of advice. The amateurs try to eliminate risk. The professionals accept it and position accordingly. Think about that difference. One group lives in denial. The other lives in reality. Guess which one survives? Larry Hite built his entire philosophy on one question. What's the worst thing that can happen, and can I survive it? Not avoid it, survive it. He assumed he'd be wrong, assumed markets would gap against him, assumed the worst-case scenario. Then he sized positions so that when, not if, disaster struck, he'd still be trading tomorrow. Real risk management isn't about stop losses. It's about position sizing. Paul Tudor Jones never risked more than 1 to 2% per trade. Not because he was scared, because he was smart. He knew that at 1% risk, he could be wrong 20 times in a row and still have 82% of his capital. At 5% risk, 7 losses and you're cut in half. The math is brutal. Lose 50%, you need 100% to break even. Lose 75%, you need 300%. Lose 90%, you need 900%. The market wizards understood this asymmetry. That's why they were obsessed with avoiding large losses, not finding large wins. But here's what separates good risk management from great. Understanding that financial risk is only half the equation. There's also psychological risk. The risk of tilting, of revenge trading, of losing discipline. Marty Schwartz knew this. He tracked his emotional state like a position. If he felt off, angry, desperate, overconfident, he'd cut his size or stop trading entirely. Not because the market changed, because he changed. And he knew that an emotionally compromised trader is a walking disaster. Picture two traders. Both risk 1% per trade financially. But trader A knows that 3 losses in a row trigger revenge trading. So after 2 losses, he stops. Trader B ignores his patterns, takes loss 3, tilts, and blows up. Same financial risk management, completely different outcomes. The formula is simple, but not easy. 1. Define maximum financial risk per trade, 1 to 2%. 2. Define maximum daily, weekly loss limits. 3. Know your psychological breaking points. 4. Build circuit breakers before you need them. 5. Honor them religiously. Ed Seykota said, "There are old traders and bold traders, but no old bold traders. The survivors aren't the ones who avoided all risk. They're the ones who took calculated risks they could psychologically and financially afford. Over and over, without exception. Risk isn't your enemy, denial is. Accept that losses are coming. Plan for them. Size for them. Build your entire approach around surviving them. Do this, and something magical happens. You stop fearing risk and start respecting it. And when fear leaves, clarity enters. But clarity alone isn't enough. You need something more powerful than motivation. You need systematic obsession. Section 7. The compound effect of boring excellence. Watch a professional athlete practice. Same drills, same routines, day after day. Boring, repetitive, mundane. Now, watch an amateur, always looking for the exciting new technique, the secret move, the shortcut. One builds greatness through repetition, the other builds nothing. Trading works the same way. Marty Pitbull Schwartz didn't become legendary through exotic strategies. He did it through religious devotion to process. Every morning, same routine. Review positions, check levels, set alerts. Every trade, same checklist. Entry rules, position size, stop loss. Every evening, same review. What worked, what didn't, what to improve. Exciting? No. Effective? His returns averaged 25 to 30% per month for years. What's one boring process you'll commit to for 30 days? Journal entries, morning prep, trade reviews, drop it below. Make it public. Accountability creates habits. The 95% chase dopamine, new strategies, hot tips, Discord alerts. They mistake activity for progress. The 5% chase process. They understand something profound. Excellence isn't built in moments of inspiration. It's built in the daily grind nobody sees. Tom Baldwin started as a $25,000 trader in the Treasury bond pit, became one of the biggest locals in history. His edge? He stood in the same spot every day, watched the same traders, noticed their patterns, their tells, their habits. While others jumped from market to market, Tom went deep. Repetition revealed what variety never could. Process compounds like interest. Each day you follow your routine, you build neural pathways. Each trade you document, you refine pattern recognition. Each rule you honor, you strengthen discipline. It's invisible day to day. But over months, years, the compound effect is staggering. Here's what real process looks like. Morning ritual, non-negotiable. Review yesterday's trades, check economic calendar, mark. Key levels, write your trading thesis. Set position, sizes before markets open. During trading, follow entry checklist, no exceptions. Document trade rationale in real time, take screenshots at entry, exit note. Emotional state, 1 to 10 scale. Evening review, score execution quality, not P&L. Identify one improvement, prep tomorrow's watch list, close all screens by set time. Boring? Absolutely. But Linda Raschke followed similar routines for decades. So did Michael Marcus. So did every market wizard. Because they understood. Amateur traders focus on outcomes. Professional traders focus on process. And process, repeated relentlessly, creates outcomes. The paradox? The more boring your trading becomes, the more exciting your results. When execution becomes automatic, psychology stabilizes. When psychology stabilizes, edge manifests. When edge manifests consistently, accounts grow exponentially. But process without flexibility becomes a prison. Markets evolve, conditions change. The question becomes, how do you stay disciplined while staying adaptive? Here's the paradox that breaks rigid traders. The more disciplined you become, the more flexible you must be. Not flexible with rules, flexible with reality. Because markets don't care about your system, they change. And if you can't evolve intelligently, you'll be disciplined all the way to bankruptcy. Ed Sikota understood this better than anyone, trend follower for decades, but not blindly. He famously said, "The markets are the same now as they were 5 or 10 years ago because they keep changing, just as they did then." Read that again. The consistency is in the change itself. Richard Dennis made hundreds of millions trend following in the 1970s and 80s. Then markets shifted, trends shortened, volatility patterns changed. Lesser traders clung to what worked before. Dennis adapted, shifted time frames, adjusted position sizing, evolved his approach while maintaining his principles. That's the difference between rigidity and discipline. The evolution framework used by market wizards, core principles, never change. Risk management rules, position sizing formulas, emotional circuit breakers, process commitments, tactical elements constantly refined, entry gestion exit signals, market selection, time frame focus, volatility adjustments. Think of it like martial arts. The fundamental principles, balance, leverage, timing, never change. But techniques adapt to opponents. Trading requires the same intelligent flexibility. Stanley Druckenmiller demonstrated this perfectly. Started as a value investor, evolved into a macro trader under Soros, changed his approach completely, but kept his risk discipline intact. Result? 30% average annual returns with no losing years. Reality check. Markets don't announce when they change. By the time it's obvious, your account is already bleeding. The key is building feedback loops that detect shifts early. Here's how to evolve without chaos. Monthly deep dive, tag all trades, trending or ranging, news-driven. Calculate win rates by market condition. Track which setups are decaying. Note new patterns emerging. Quarterly strategy. Review, compare current performance to baseline, identify environmental changes. Test small adjustments, 10% of capital max. Document what's working, what's failing. Annual evolution, major strategy modifications if needed. Add new markets, instruments, adjust to regulatory changes, upgrade technology, check tools. The key, evolution must be data-driven, not emotion-driven. When you lose 3 trades, that's variance. When your win rate drops 20% over 50 trades, that's signal. Learn the difference. Paul Tudor Jones rebuilt his approach multiple times, from cotton trader to global macro master. But his evolution was structured, planned, based on evidence, not panic. He once said, "I'm always thinking about losing money as opposed to making money." That defensive mindset allowed aggressive evolution. The traders who survive decades aren't stubborn or random. They're intelligently adaptive. They honor their core principles while adjusting their tactics. They evolve like rivers, maintaining direction while shifting course around obstacles. But all this adaptation requires energy, focus, presence. What happens when the well runs dry? When you've been staring at screens so long you can't see straight. That's when the greatest edge becomes the ability to do absolutely nothing. Section 9, The Profitable Art of Waiting. Mark Minervini won the U.S. Investing Championship with a 155% return. Want to know his secret weapon? He did nothing 90% of the time. Literally nothing. No trades, no positions, just watching, waiting, preparing. Then when his moment arrived, full conviction, full size, full focus. The amateur thinks trading is about action. The professional knows it's about patience. And patience isn't passive. It's the most intense form of discipline. How many B-grade setups did you force this week because you were bored? Be honest. Drop the number below. Awareness is the first step. Jesse Livermore called it sitting tight. He'd watch markets for weeks without trading. Not because he couldn't find setups, because he was waiting for the perfect setup, the one that screamed opportunity. He understood something the 95% never grasp. The money isn't made in trading, it's made in waiting. Here's what waiting really means. You're fully prepared, charts marked, levels set, capital ready. But you don't move until your exact criteria align. Not close enough, not probably works, exact, precise, undeniable. Jim Rogers took this to extremes. He'd go years without major trades. Years. While others churned accounts daily, Rogers waited for massive distortions. When he found them, he bet big and held long. His patience made him rich enough to retire at 37 and motorcycle around the world. The psychology of waiting is brutal. Your mind creates phantom opportunities. That could be a setup. Maybe I should get in early. Everyone else is trading. These aren't thoughts, they're addiction symptoms. The need for action, for dopamine, for the feeling of being in the game. Picture yourself tomorrow at 10 a.m. No setups match your criteria. By noon, still nothing. By 2 p.m., you're checking lower time frames. By 3 p.m., you're adjusting criteria. By close, you've taken 3 subpar trades. All losers. Not because the market was wrong, because you couldn't handle the silence. David Ryan, 3-time U.S. investing champion, had a rule. If you're bored, you're not looking hard enough at what you already have. Instead of forcing trades, he'd study past winners, refine his watch list, prepare for the next opportunity. Active patience. The math supports waiting. 1 A+ setup with full size beats 20 B- setups every time. If your edge gives you 70% win rate on perfect setups but 45% on close enough setups, which would you rather take? The answer is obvious. The execution is agony. Waiting is a skill. Train it like one. Define your A+ setup in writing. Track how many appear weekly. It's less than you think. Celebrate days you don't trade. They saved you money. Find productive waiting activities. Research, not Netflix. Because here's the truth. In a world of overtraders, patience is alpha. When everyone else is forcing marginal trades, depleting capital and confidence, you're preserving both for the moments that matter. William O'Neill sometimes waited months for his perfect pattern. Months, but when it appeared. He'd make his year in weeks. That's not luck. That's the compound effect of patience meeting preparation. The paradox, the less you trade, the more you make. But only if you're waiting for the right reasons. Waiting from fear is paralysis. Waiting from discipline is power. Learn the difference and you'll understand why the best traders do nothing most of the time. But what fuels this kind of patience? What makes someone able to wait weeks for the perfect setup while others crack after hours? It's not willpower, it's something deeper. Section 10. Confidence, the evidence-based edge. Confidence in trading isn't what you think. It's not a feeling you wake up with, not something you download from a motivational video. And it definitely doesn't come from your last winning trade. Real confidence is evidence-based. It's earned in the space between what you say you'll do and what you actually do. And that gap, it's where 95% of traders lose the game. Michael Marcus rebuilt his confidence 7 times, after 7 blown accounts. How? He stopped trying to feel confident and started building proof. Small account, small trades, perfect execution. Each followed rule was a deposit. Each honored stop was evidence. By the time he scaled up, his confidence wasn't hope. It was historical fact. Still here? Good. We're deep in the psychology now. If your mind is racing with, I should do this, or I'm guilty of that, perfect. Awareness is uncomfortable. Growth lives in that discomfort. Watch how confidence actually builds. Monday. You plan to take only A+ setups. An A+ appears, you take it, it loses. You don't revenge trade, that's a win. Tuesday, B+ setup tempts you, you pass, another win. Wednesday, A+ setup in ugly market conditions. You take it with half size, as your rules state. Another win. By Friday, you've had 3 losing trades and 2 break even, financially flat. But psychologically, you're building an empire. Because confidence doesn't come from profits, it comes from proof that you can trust yourself under pressure. Linda Rashka understood this. Confidence is not, I will win. Confidence is, I will be okay when I lose. Read that again. The difference is everything. One creates pressure, the other creates freedom. And freedom is where peak performance lives. The confidence formula. Market wizards follow. 1. Make micro commitments. 1 rule 1 day. 2. Keep them regardless of outcome. 3. Document the evidence. 4. Stack proof over time. 5. Let confidence emerge naturally. The 95% do it backwards. They try to feel confident first, then trade from that feeling. But feelings without evidence are delusions. The market specializes in destroying delusions. Here's a practical exercise. Create a trust account. Every time you follow your process, win or lose, make a deposit. Every time you break rules, profitable or not, make a withdrawal. Track this separately from P&L. After 30 days, you'll see your real balance. Not money, trust. And trust is the foundation and confidence is built on. Bruce Kovner said something profound. I know where I'm getting out before I get in. That's not about stop losses. It's about self-trust. He knows he'll honor his exit no matter what happens. No hoping, no praying, just execution. That certainty, built over thousands of trades, is real confidence. But here's what most miss. Confidence isn't loud. The most confident traders are often the quietest. They don't need to prove anything because they've already proven it to themselves. In the privacy of their own execution, trade by trade, rule by rule. Paul Tudor Jones in his early days versus his later years, night and day. Young PTJ was brash, aggressive, needed to be right. Mature PTJ, calm, methodical, focused on process. Same intelligence, same markets, different confidence source. One based on ego, one based on evidence. The transition happens when you stop needing any single trade to work. When your identity isn't tied to today's P&L, when you trust your edge and your ability to execute it over time. That's not a feeling, it's a knowing, and knowing changes everything. But what happens when that knowing gets shattered, when discipline fails and you spiral? That's when you need the skill nobody talks about. Section 11, the recovery protocol. Every trader has a breaking point, every single one. Paul Tudor Jones punched his screen after a huge loss early in his career. Michael Marcus blew out 7 times. Even Ed Seykota had periods of doubt. The difference between legends and failures isn't that one group never breaks, it's how fast they recover. I'm going to tell you about the spiral because you need to recognize it before it destroys you. It starts small. A good trade turns bad. You hold past your stop, just this once. It reverses further. Now you're in psychological debt. Not just financial loss, emotional loss. Your identity as a disciplined trader is threatened. So, you double down, not on the position, on the narrative. I'll make it back on the next trade. But you're not trading anymore. You're gambling with scared money. Your judgment is compromised. Risk management disappears. Within hours or days, a manageable loss becomes a career-threatening catastrophe. Screenshot this recovery protocol. Save it where you'll find it when you need it, because you will need it. Every trader does. The immediate recovery. Protocol, hour 1 to 24, full stop. Close all positions, no exceptions. Shut down platforms, leave your trading space physically. No financial news, no charts, no Discord. Day 2 to 3, document without judgment. Write the sequence of events. Note the trigger moment. Track the emotional progression. Identify the first rule. Break. Day 4 to 7, physical and mental. Reset exercise differently than normal. Sleep 8+ hours. Eat real food. Talk to someone outside trading. Week 2, forensic analysis review. With fresh eyes, identify pattern similarities to past spirals, build specific circuit breakers, create if-then protocols. Week 3, micro re-entry trade, 10% of normal size, only A+ setups, focus on execution, not profit. Document everything. Stanley Druckenmiller lost $3 billion in the tech crash, $3 billion, but he came back. How? He didn't try to make it back quickly. He rebuilt slowly, methodically, like a fighter returning from injury, light sparring before heavy rounds. The biggest mistake traders make post-blow-up, trying to return to normal size immediately. Your nervous system isn't ready. Your confidence is shattered. You need wins, small ones, to rebuild the foundation. Richard Dennis had a brilliant rule. When you're in a losing streak, you can't turn it around with one trade. You're not going to hit a home run. You just have to get singles, and that's very hard to do. The recovery mindset that works. This is data, not failure. Every trader has these moments. Recovery skill is more valuable than never failing. Small wins compound into big comebacks. Time is your ally, not your enemy. Larry Hite blew up early in his career, lost everything. But he said something powerful. I learn more from my failures than my successes. Success teaches you what works once. Failure teaches you what never works. The traders who last 20+ years aren't the ones who never fail. They're the ones who fail better each time. Faster recognition, smaller damage, quicker recovery. They build antibodies to their own destruction patterns. Because here's the truth. The market will break you multiple times. That's not a possibility. It's a certainty. Your edge isn't in avoiding breaks. It's in recovering before the break becomes your identity. Master this, and you become psychologically unkillable. But once you've learned to recover, you face trading's final challenge: how to grow without letting growth destroy you. Section 12. Scaling success without scaling ego. Success in trading creates a unique problem. The better you get, the more dangerous you become to yourself. Because nothing corrupts discipline faster than a swelling account and a swelling head. The graveyard of trading is littered with people who mastered the game, then let the game master them. Long-term capital management. Nobel Prize winners, PhDs, the smartest minds in finance, turned $1 billion into $4, $6 billion, then leveraged it 25 to 1 because they were too smart to fail. Lost 90% in 5 weeks, nearly collapsed the global financial system, not because their models were wrong, because their egos were unchecked. The scaling paradox. Your brain doesn't process gains and losses proportionally. A $100 loss hurts. A $10,000 loss traumatizes. But here's the hidden danger. A $100,000 gain intoxicates. It whispers lies. You've figured it out. You're special. Rules are for average traders. Victor Niederhofer made millions, featured in journals, Soros's chosen trader. Then he started believing his press, ignored his stops because he knew better, over-leveraged because he was due for a win, blew up spectacularly, twice. Genius-level intelligence, amateur-level humility. Here's how to scale without self-destructing. Financial scaling, the easy part. Increase size, maximum 25% at a time. Only after 20+ trades at current size must feel emotionally neutral at current level. Keep risk percentage constant, never increase. Psychological scaling, the hard part. Journal confidence levels daily, 1 to 10. Watch for ego. Inflation signals. Maintain beginner's mindset. Remember, size amplifies everything, including mistakes. Paul Tudor Jones scaled from thousands to billions. But notice what didn't scale, his paranoia. He remained terrified of big losses, obsessed with risk control. His famous quote, "I think I am the single most conservative investor on earth." This from a man managing billions. That paranoia kept him alive. Warning signs. You're scaling ego, not just size, skipping your usual prep work, taking obvious trades without full analysis, increasing risk percentage just for this trade, feeling invincible after winning streaks, talking more about wins than process. The solution isn't to stay small forever. It's to scale mechanically, not emotionally. Your identity shouldn't change with your account size. The discipline that made you profitable at 10K must remain at 1 Youre. Actually, it must intensify. George Soros understood this. As his fund grew, his process became more rigorous, not less. More analysis, more risk controls, more devil's advocates. He knew something crucial. The bigger you get, the bigger your blind spots. The master's scaling formula. Scale size gradually, months, not days. Scale process proportionally. More size equals more discipline. Scale humility inversely. Bigger account equals smaller ego. Scale paranoia constantly. Success breeds complacency. Here's the test. Can you take the same percentage loss at your new size without emotional damage? If losing 1% at $1 million feels worse than losing 1% at 100K, you're not ready. Your nervous system hasn't adapted. Scale back until boring returns. Michael Steinhardt averaged 24% annually for 28 years. His secret? He never forgot that markets can humble anyone, anytime. He stayed hungry, stayed scared, stayed disciplined. The money scaled, the mindset didn't. Remember, the market doesn't care about your past performance. Every day, you're only as good as your next trade. The moment you forget that, the moment size makes you feel special, you've already started your countdown to destruction. But to maintain this mindset through decades of trading, you need something beyond discipline. You need a life that supports your edge. Section 13. The ecosystem of excellence. Trading isn't performed in a vacuum, yet most traders build their entire world around screens, forgetting they're human beings, not execution machines. The market wizards understood something deeper. Sustainable success requires an ecosystem that supports your edge, not just a strategy that exploits it. Jack Schwager noticed a pattern. The traders who lasted decades didn't just have better systems. They had better lives, structured, balanced, intentional. They treated themselves like professional athletes because they understood. You are the instrument. If the instrument breaks, the music stops. Martin Schwartz's ecosystem was religious. At 4:30 a.m. wake up every single day. Physical workout before markets. Same breakfast, same routine. Trade only from his office, never home. Hard stop at market close. Evening squash games, competitive outlet. Lights out by 9 p.m. Obsessive? Maybe. But it gave him the physical and mental energy to trade with intensity for hours. Then disconnect completely. No wonder he averaged 25 to 30% monthly returns. His edge wasn't just in reading tape, it was in managing energy. Rate your current setup 1 to 10. Physical environment, clean, dedicated, distraction-free. Daily routines, consistent sleep, exercise, nutrition. Mental boundaries. Can you disconnect from markets? Support system. Who knows your struggles? Recovery activities. What recharges you? If you scored below 7 in any area, that's your weakest link. The physical space matters more than you think. Linda Rashka had a specific chair, specific monitors, specific setup, not superstition, environmental anchoring. Her brain associated that space with peak performance. Home was for family. Office was for war. But the ecosystem goes beyond physical. It's about rhythms, boundaries, restoration. Jim Rogers traveled the world twice, not running from trading, integrating it into life. His travels informed his macro views. His adventures recharged his spirit. He understood. The best trades come from a clear mind, not a cluttered one. Most traders burn out because they have no off switch. They check futures at 3 a.m., watch charts during dinner, dream about positions. That's not dedication, it's addiction. And addiction destroys judgment. The professional's ecosystem: morning foundation, consistent wake time, physical movement, non-negotiable, mental preparation ritual, nutrition that supports focus, trading hours, dedicated space, no exceptions. Phone in another room, scheduled breaks every 90 minutes, hard stop time, evening recovery, transition ritual, shower, walk, music, non-market activities, human connection, quality sleep, 8+ hours, weekly rhythms, 1 full day offline, physical challenges, creative pursuits, social connections. Paul Tudor Jones played tennis. Bruce Kovner studied classical music. Michael Marcus meditated. Different outlets, same principle. You need somewhere to channel intensity besides markets. The ecosystem isn't about balance, it's about sustainability. You're not trying to work less, you're trying to work better, longer, without breaking. Think decades, not days. Because here's what happens without an ecosystem. Year 1, pure passion. Year 2, grinding fatigue. Year 3, chronic stress. Year 5, health problems. Year 7, forced retirement. All that skill wasted on unsustainable intensity. But with the right ecosystem, you evolve, you last. You compound not just returns, but capabilities. The ecosystem holds you up when motivation fails, when discipline wavers, when markets test your sanity. And when you've built this foundation, when structure and support and process all align, something magical happens. The conscious becomes unconscious. The mechanical becomes intuitive. And that's when trading transforms into art. Section 14, when instinct becomes edge. After 10,000 hours of deliberate practice, something shifts. The charts start speaking a language beyond words. You sense moves before they manifest. Not psychic ability, pattern recognition so refined it bypasses conscious thought. This is the final evolution, when knowledge becomes knowing. Paul Tudor Jones demonstrated this in 1987. He called the crash with eerie precision, not through complex models, through feel. Years of observation had trained his subconscious to recognize danger patterns. His conscious mind couldn't articulate why. His gut knew. He made 60% while markets collapsed 22% in one day. But here's the critical distinction. Intuition isn't emotion. It's compressed expertise. The difference between I feel bullish, emotion, and something's off here, intuition, is decades of disciplined observation. True trading intuition has specific qualities. Arrives quietly, without urgency. Feels neutral, not emotional. Doesn't argue or justify itself. Often contradicts what you want, becomes clearer with stillness. George Soros called it the ache, physical discomfort when positions were wrong. His body processed market information faster than his mind. But that sensitivity took decades to develop. And more importantly, he still verified with analysis. Intuition informed decisions. It didn't replace process. The path to intuition is counterintuitive. You don't develop it by trying to feel markets. You develop it by following rules so religiously that your subconscious internalizes every nuance. Like a chess grandmaster who sees 20 moves ahead, not through calculation, but through pattern recognition. Michael Marcus described the evolution. Years, 1 to 3, everything is conscious, effortful. Years 4 to 7, patterns become familiar. Years 8 to 10, recognition becomes automatic. Years 10 plus, this intuition emerges naturally. But beware false intuition. Every amateur thinks they have gut feelings. Usually it's just hope, fear, or greed in disguise. Real intuition whispers. Fake intuition shouts. Real intuition can wait. Fake intuition demands immediate action. For 1 month, journal every gut feeling about a trade before you act. Note what exactly you sensed, how it felt physically, whether you acted on it, what actually happened. After 30 days, analyze. You'll quickly separate real intuition from emotional noise. The integration is crucial. Intuition doesn't replace your system, it enhances it. Your rules say enter. Your gut says wait. You enter with half size. That's mastery, using intuition as information, not instruction. Jesse Livermore had a rule: there is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. His intuition wasn't mystical. It was pattern recognition from studying those repetitions. The paradox: intuition only emerges when you stop forcing it. Like sleep, the harder you try, the more elusive it becomes. Focus on process. Honor your rules. Pay attention without attachment. One day, you'll sense something subtle, a hesitation in momentum, a distribution pattern forming. You won't know how you know. You'll just know. And when that happens, when mechanical excellence evolves into intuitive mastery, you'll understand why the greatest traders seem to have a sixth sense. They don't. They have a trained sense, built on millions of observations, refined through thousands of trades, earned through decades of discipline. But even intuitive mastery serves something greater, because once you've conquered the game, why keep playing? After all the systems, all the discipline, all the evolution, every great trader faces the same question. What's the point? You've made your money, proven your skill, conquered your demons. The market that once terrified you now feels like home. So, why continue? The answer reveals the deepest truth about trading. Jim Rogers retired at 37. Had all the money he'd ever need, traveled the world on a motorcycle, wrote books, taught. But he kept studying markets, not for profit, for understanding. Because somewhere along the journey, he discovered what trading really offers: the purest education in reality available to civilians. Markets teach what universities can't. They're laboratories of human nature, mirrors of mass psychology, brutal teachers of cause and effect. Every day they demonstrate how the world actually works versus how we wish it worked. That education, that clarity, becomes addictive in the best way. Ray Dalio built the world's largest hedge fund, but his greatest creation? His principles. Universal truths discovered through markets, but applicable everywhere. About decision-making, about reality, about evolution. The markets were his dojo. The wisdom was the real prize. Look at what trading really teaches: emotional mastery. You learn to function rationally while risking capital. That skill transfers everywhere: negotiations, relationships, life decisions. The person who can stay calm, losing $50,000, can handle any crisis. Reality. Acceptance. Markets don't care about your opinions. Only reality matters. This brutal honesty becomes a superpower in a world full of delusion. You see things as they are, not as you wish. Process thinking. Success comes from repetitive excellence, not sporadic brilliance. This understanding transforms how you approach everything: fitness, learning, building businesses. Risk intelligence. You understand probability in your bones, not theoretically, practically. This makes you better at every decision, from investments to relationships to health choices. Humility and confidence. Markets humble everyone, but reward those who persist intelligently. You develop rare combination: confidence in your process, humility about outcomes. Michael Marcus said it best: trading gives you the opportunity to learn about yourself in ways that no other endeavor can. It's immediate, it's real, and it's unforgiving. But if you survive and thrive, you emerge transformed. The traders who last aren't motivated by money after a certain point. They're motivated by mastery, by the elegance of reading markets correctly, by the satisfaction of disciplined execution, by the continuous learning. Money becomes scorecard, not goal. But the greatest gift? Trading teaches you how to live, how to handle uncertainty because life is uncertain, how to manage risk because everything involves risk, how to stay disciplined because discipline determines destiny, how to evolve because stagnation equals death, how to accept losses because loss is universal, how to maintain perspective because perspective is sanity. The market was never your enemy. It was your teacher, your therapist, your monastery. It demanded you face every weakness, challenged every assumption, punished every delusion. And if you survived that trial, if you emerged profitable in money and wisdom, you gained something priceless: a trained mind, a disciplined spirit, an educated intuition, and the knowledge that you can handle whatever comes next, in markets or in life. Because the most important trade was never about money. It was about who you became in the pursuit. And that transformation, That's the only trade that truly matters. The market will be there tomorrow. The question is, who will you be when you meet it? If you've made it this far, you've already separated yourself from the 95%. They clicked away at the first mention of discipline, but you stayed, you absorbed, you recognized yourself in these stories, both the failures and the possibilities. So here's my challenge. Don't let this be another video you consume and forget. Tomorrow morning, before markets open, do 3 things. 1. Write 1 sentence. What am I really trading, the market or myself? 2. Choose 1 principle from this video to implement for 30 days. 3. Document it publicly for accountability. Comment below with this format. I'm building the edge within. For the next 30 days, I commit to specific action. Maybe it's journaling every trade. Maybe it's honoring stops without exception. Maybe it's walking away after 2 losses. Pick 1 thing, master it, then stack the next. If this hit different, if you felt exposed, challenged, or inspired, share it with 1 trader who's ready for truth. Not the gamblers chasing quick wins, but that person grinding in silence, searching for the missing piece. They need to hear this. The missing piece isn't in the market, it's in the mirror. Subscribe if you're ready for more uncomfortable truths about trading and life. This channel isn't for the masses. It's for the few who understand. Mastery isn't a destination. It's a daily practice. And hit the notification bell, because the next video breaks down the exact journaling system used by a trader who turned $5,000 into $12 million. Not theory, not motivation, pure executable process. Remember, you're not trading the market, you're trading yourself. The market keeps score. Your job is to become someone worth betting on. See you tomorrow, same time, better trader. Save this video. You'll need it during your next drawdown, and the one after that. Because mastery isn't about never falling, it's about how fast you stand back up. I turned 583.15 into 107.6698 in 16 days. That's the post that destroyed thousands of trading accounts in 2021. A Reddit user's GME YOLO screenshot that went viral, spawning an army of disciples who thought they'd found the Holy Grail. What they didn't see? The 99% who tried to replicate it and turned $10,000 into $1,000 in 3 days. Here's what nobody talks about. That legendary trader, even he couldn't replicate his own success. Because even lottery winners can't win twice with the same numbers. 3 a.m. Manhattan. I'm staring at my screen, watching a 24-year-old's TikTok about making 50K day trading while sipping cocktails in Bali. The comments, thousands asking, what's your strategy? Wrong question. The right question, what's your discipline system? Because here's the cold truth. Jesse Livermore, the greatest trader who ever lived, made and lost millions 4 times. Not because he couldn't read the market, but because he couldn't follow his own rules. He literally wrote the book on trading, then died broke with a bullet in his head. Welcome to the Trading Psychology Stick, where we transform emotional gamblers into systematic professionals. Quick disclaimer, this isn't about hot stock tips or the next crypto moonshot. This is about the only edge that matters, the 6 inches between your ears. Today's transformation promise. You're about to discover why 90% of traders fail within 90 days, and it has nothing to do with their strategy. You'll learn the exact framework used by prop trading firms that turn rookies into profitable traders, not through better indicators, but through unbreakable systems. I've analyzed over 1,000 trading journals, interviewed traders managing billions at Renaissance Technologies, Millennium Management, and Jane Street. The pattern is always the same. Process separates survivors from statistics. Every day you trade without discipline, you're not investing. You're playing Russian roulette with 5 bullets in the chamber. The house always wins against the undisciplined. Let's begin your journey across the financial desert. Chapter 1. The Mirage of Easy Money. In 1929, a shoeshine boy gave Joseph Kennedy a stock tip. Kennedy sold everything the next day. The market crashed a week later. When everyone sees an oasis in the desert, it's usually a mirage. Trading without discipline is like following every water source in the Sahara. The more desperately you chase, the deeper into danger you wander. The market's greatest illusion isn't that money is easy to make, it's that you can make it without rules. Picture the Nikkei trading floor, 1989. Japan's economy is unstoppable. Tokyo real estate is worth more than all of California. Mrs. Watanabe, the archetypal Japanese housewife, is now a day trader. Golf club memberships are trading like stocks. Taxi drivers discuss P/E ratios. Everyone's a genius in a bull market. A young trader at Nomura Securities watches his colleagues buy their third Mercedes. The bank's Christmas party features champagne that costs more than most annual salaries. The market only goes up, his boss declares, lighting a cigar with a 10,000 yen note. Fast forward 12 months, the Nikkei has crashed 50%. That same boss is selling his Mercedes. Mrs. Watanabe has lost her family's savings. The young trader? He's one of the few with a job because he was the only one following position, sizing rules, while everyone else was leveraged to their eyeballs. The Nikkei wouldn't recover for 34 years. Or take the dot-com boom. Pets.com spent $1.2 million on a Super Bowl ad while losing $147 million a year. Traders valued eyeballs over earnings. This time is different, they said. Warren Buffett was mocked as a dinosaur for avoiding tech stocks. He doesn't get it, CNBC pundits laughed. The Nasdaq dropped 78%. Buffett's Berkshire gained 40%. What these stories really reveal isn't market cycles. It's human nature on repeat. The mirage of easy money appears in every generation, just wearing different clothes. 1720, South Sea bubble, trade with South America. 1929, radio stocks, the future of communication. 1999, internet stocks, the new economy. 2021, meme stocks, we like the stock. 2024, AI stocks, this changes everything. The pattern never changes because human psychology never changes. Fear and greed are emotions that drive market participants to make irrational decisions. The market is a voting machine in the short term and a weighing machine in the long term, as Benjamin Graham said. But here's what he didn't add. Without discipline, you'll always be voting with the mob. When was the last time you took a trade because everyone else was doing it? Think about it for a moment. When did you last buy something not because of analysis, but because you couldn't stand watching it go up without you? What if the biggest trades of your life were the ones you didn't take? What if your edge wasn't finding the next Amazon, but having the discipline to avoid the next Pets.com? Ray Dalio built the world's largest hedge fund with one core principle. He who lives by the crystal ball will eat shattered glass. But knowing history isn't enough, because right now, 3 psychological demons are hunting you in the financial desert. They've killed more trading accounts than all the market crashes combined, and they're probably on your screen right now. Chapter 2. The 3 Demons of Indiscipline. Nick Leeson brought down a 233-year-old bank with 3 emotions: fear, greed, and FOMO. Total damage, $1.3 billion. 3 psychological demons stalk every trader through the financial desert. They're not market conditions or bad luck. They're internal assassins. Trading psychology refers to the emotional and mental aspects that influence your trading decisions and behavior. These demons have destroyed more wealth than all market crashes combined. February 1995. Nick Leeson, a 28-year-old trader at Barings Bank, sits in Singapore staring at his screens. It started with fear, a small loss on Nikkei futures, just $20,000. But fear whispered, hide it, you'll get fired. So he created a secret error account, 88888. Then came greed. The loss grew to $200,000. Greed said, double down. One big win and you're clear. He bought more contracts. The Kobe earthquake hit. Losses exploded to $800 million. Finally, FOMO arrived. Other traders were making fortunes on the volatility. This is your chance, FOMO screamed. Go all in. Leeson fled Singapore with losses totaling $827 million, or $1.3 billion. Barings Bank, which had financed the Napoleonic Wars, collapsed in a week. But here's the thing. Leeson wasn't stupid. He'd been Barings' star trader, making $10 million in profits the previous year. The demons don't care about your IQ. Look at long-term capital management, Nobel laureates, MIT professors, the smartest minds in finance. Their models were perfect. Their execution wasn't. When Russia defaulted in 1998, fear made them freeze. Greed had them leveraged 25-1. FOMO had them in every exotic trade imaginable. Loss, $4.6 billion. The Fed had to organize a bailout to prevent global financial collapse. Emotions can have a profound impact on your trading performance. Fear can lead to closing positions too early, while greed might result in holding on to losing positions for too long. But here's the deeper truth. These demons are features, not bugs. They're evolutionary survival mechanisms. Fear kept our ancestors alive. That rustling might be a tiger. Greed ensured resource accumulation, store food for winter. FOMO maintained tribal cohesion, don't get left behind. In the savannah, these emotions saved lives. In the market, they destroy accounts. The real insight? You can't delete these programs. They're hardwired. But you can build a system stronger than your wiring. That's what institutional traders do. That's why Millennium's traders don't panic sell during crashes and while retail traders capitulate. As Stan Druckenmiller says, the way to build long-term returns is through preservation of capital. Which demon owns you? Is it fear that makes you cut winners short? Fear drives premature exit from profitable trades or prevents entry into valid setups. Is it greed that makes you hold losers too long? Remember, Jesse Livermore said, "It was never my thinking that made big money for me. It was always my sitting." Is it FOMO that makes you chase breakouts at the top? Here's an exercise. Write down your last 10 trades. Next to each, write F for fear, G for greed, or F for FOMO, based on what emotion influenced it. If more than 3 have letters, you're trading emotionally, not logically. Pause this video and do it now. What patterns do you see? Now you know the demons' names, but naming them isn't enough. Let me show you the real cost when these demons drive your trading decisions. Spoiler, it's not just money you lose. Chapter 3, The Cost of Walking Without Rules. Bill Hwang lost $20 billion in 2 days. Not because markets crashed, because he ignored every risk rule ever written. Every undisciplined step in the financial desert doesn't just cost money, it compounds into catastrophe. Like interest on a credit card you can't pay, each rule you break multiplies the damage exponentially. The cost isn't linear, it's logarithmic. March 2021. Bill Hwang runs Archegos Capital from a Manhattan office overlooking Central Park. Former Tiger Cub. Managed $10 billion. Smart guy. But smart doesn't equal disciplined. Rule break. Number 1, position sizing. Instead of risking 1 to 2% per trade, Hwang leveraged 5 to 1. On paper, his $10 billion controlled $50 billion in positions. Rule break number 2, diversification. 80% concentrated in just 8 stocks. When Viacom CBS announced a share offering, the stock dropped 9%. For Hwang, that meant $800 million gone in hours. Rule break number 3, stop losses. No stops, no hedges, just hope. As positions fell, margin calls started. Goldman Sachs alone dumped $10.5 billion his positions in a day. Total damage, $20 billion vaporized in 48 hours. Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion. Hwang lost everything. But here's what's worse than losing $20 billion, the human cost. Take the London whale, Bruno Ixil, JP Morgan trader who lost $6.2 billion in 2012. The financial media fixated on the number. What they missed? Ixil hasn't traded since. 13 years of skill destroyed by 6 months of undisciplined trading. Or consider the retail casualties. The Wall Street Bets subreddit is littered with screenshots. Lost my kid's college fund on SPY 0DTE options, down 180K, getting divorced, bankruptcy at 26, started with 5K. Revenge trading after losses can result in further losses of 25 to 40% of trading capital. The market has a brutal accounting system. Every broken rule carries a price. Trade without stops, pay with your account. Ignore position sizing, pay with your portfolio. Revenge trade, pay with your relationships. Overtrade, pay with your health. As Ed Seykota said, win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing money. The deeper cost is psychological. A systematic approach ensures that traders consistently follow their established strategies and plans. This helps in building a track record of successful trading over time. Without it, you're not building a trading career, you're funding someone else's. Think about it. Every emotional trader's loss is a systematic trader's gain. The market is a zero-sum game. When you revenge trade, a Renaissance algorithm thanks you. When you FOMO buy the top, a 2 sigma model profits. You're either predator or prey. Your system decides which. Add up your losses from the last year, not just the number, the real cost. How many of those losses came from breaking your own rules? How many from trades you knew you shouldn't take? Now multiply that by 10 years. That's your tuition to the University of Indiscipline. What if every rule you followed saved you money? What if discipline wasn't a restriction, but a wealth preservation system? Here's the uncomfortable truth. You already know what to do, you just don't do it. The gap between knowing and doing is where accounts go to die. But enough about the cost. You get it. The desert is dangerous. The demons are real. The price is steep. Now comes the part that changes everything. Building your trading constitution. The document that stands between you and financial ruin. So far, we've covered 3 crucial insights. First, the market creates mirages of easy money that trap undisciplined traders generation after generation. Second, 3 psychological demons, fear, greed, and FOMO, are hardwired into your brain and actively work against your trading success. Third, the cost of indiscipline isn't just financial. It compounds into career-ending and life-altering consequences. Take a deep breath. We're about to shift from understanding the problem to building the solution. Ready? Let's continue. Chapter 4, The Trading Constitution. Ray Dalio's Bridgewater has 837 principles. You need 10, but those 10 must be unbreakable. A constitution isn't just rules. It's a sacred document that governs behavior when emotions try to stage a coup. Like the U.S. Constitution has survived 247 years of chaos, your trading constitution must survive every market condition. It's your discipline made tangible. Inside Point 72's Connecticut headquarters, every new trader receives the book. Steve Cohen's trading principles accumulated over 40 years. Page 1 has just 4 words. Rules are not suggestions. One principle stands out. Never average down on losers. A hotshot new trader from Harvard thinks he knows better. Tesla drops 5%, he buys more. It's oversold, he tells his risk manager. Down 10%, he doubles down. This is the opportunity, down 15%. Risk manager walks over. What's rule number 1? Never average down, but you're done for the day. Clear your positions. The Harvard kid protests, points to his analysis, shows his models. The risk manager doesn't care. Rules are rules. The kid's trading privileges are suspended for a week. That same day, another trader at a retail prop firm averaged down on the same Tesla dip. No risk manager, no rules. He lost his entire $50,000 account by close. The difference? One operated under a trading constitution. One operated on feelings. Look at any successful trading firm. Renaissance Technologies. 39 trading rules, coded into algorithms. Optiver. Every trader signs a trading mandate. Jane Street. Principles are tested with millions in backtests before adoption. A comprehensive trading plan that outlines your goals, strategies, risk management rules, and criteria for trade entry and exit is crucial. Your trading constitution needs 5 pillars. Risk commandments. Never risk more than 1% per trade. Never have more than 3% in play at once. Stop losses are placed with orders, not in your head. Entry laws. Only trade your setups. List them specifically. No trades in first or last 30 minutes. If you can't explain it to a child, don't trade it. Exit edicts. Take profits at predetermined levels. Trail stops. Never move them against you. Time stops. If it doesn't work in X time, exit. Behavioral boundaries. No trading after 3 losses. No trading when emotional. Define this clearly. No revenge trading, ever. Review rituals. Journal every trade. Weekly performance review. Monthly strategy assessment. Paul Tudor Jones keeps his principles on a laminated card. Reads them every morning. The secret to being successful from a trading perspective is to have an indefatigable and an undying and unquenchable thirst for information and knowledge, he says. But knowledge without rules is just trivia. What rules do you break most often? Write them down. Those are your weakness points where the Constitution needs to be strongest. If you had to trade with someone watching over your shoulder, someone who would slap your hand if you broke a rule, what would change? That's what your Constitution does. It's your external discipline until discipline becomes internal. Here's the test. Can you hand your Constitution to another trader and have them trade exactly like you? If not, It's too vague. I'll cut losses quickly isn't a rule. Exit at 2% loss or 8 EMA break, whichever comes first, is a rule. Having a constitution is step one, but like any document, it's worthless without daily execution. That's where the daily discipline ritual comes in, the morning routine that separates professional traders from weekend warriors. Chapter 5. The Daily Discipline Ritual. Mark Minervini starts each day the same way for 30 years. His returns, 220% annually over 5 years. Coincidence? Discipline isn't a decision, it's a ritual. Like a samurai preparing for battle or a surgeon scrubbing in, professional traders follow pre-market routines that prime their minds for disciplined execution. Consistent trading routines create a structured framework for daily market activities. 4:30 a.m. Paul Tudor Jones's home office. While Manhattan sleeps, he's already 2 hours into his routine. First, physical state. 30 minutes of yoga. Not for flexibility, for mental clarity. Body leads mind, he says. 5 a.m. market meditation. Reviews positions with 0 screens on. Visualizes each trade playing out, both winners and losers. Mental rehearsal for emotional control. 5:30 a.m. The levels. Writes key prices by hand, not typed, handwritten. The physical act burns it into memory, he explains. Support, resistance, pivots, all from memory first, then verified. 6 a.m., the rules review, reads his trading principles aloud. Every single day, for 40 years. How can I follow rules I don't remember? 6:30 a.m., news scan. But here's the twist. He reads it with sound off first. I want to see what the market thinks before hearing what talking heads think. 7:06 a.m., trade plan, maximum 3 trades identified. Not 10, not 5, 3. Constraint breeds clarity. Compare this to the average retail trader. Wake up, check phone, see futures, panic or euphoria, open platform, scan for movers, FOMO into something, hope for the best. One is hunting, the other is being hunted. Linda Rashka, who's traded profitably for 40+ years, has an even simpler routine. I write the same thing every morning. I will follow my rules today. Then I sign it. That signature is my contract with myself. The science behind rituals is compelling. A systematic pre-market routine sets the foundation for each trading day. Dr. Brett Steenbarger's research on trading psychology shows traders with morning routines are 60% more likely to follow their rules. Physical exercise before trading improves decision-making by 23%. Writing plans by hand increases execution probability by 42%. Why? Rituals move decisions from the emotional brain, the amygdala, to the logical brain, the prefrontal cortex. You're literally rewiring your neural pathways for discipline. The military discovered this centuries ago. Why do soldiers make their beds with perfect corners? It's not about the bed. It's about starting each day with discipline. As Navy SEAL Admiral McRaven says, if you want to change the world, start by making your bed. Your trading ritual is your bed making. It's the first victory that leads to all others. What's your current morning routine? Be honest. Is it Instagram, coffee, then charts? Is it waking up at market open and scrambling? What would change if you had a non-negotiable 30-minute ritual before touching any trade button? Try this for 1 week. Wake up 30 minutes earlier. Write 3 rules you'll follow today. Identify max 3 trades. Set alerts and walk away. Only return when alerts trigger. That's it. Not complicated, but discipline rarely is. As Minervini says, successful trading is 80% psychological and 20% methodological. Yet traders spend 90% of their time on method and 10% on psychology. Your morning ritual fixes that ratio. Comment below. What one morning ritual will you commit to starting tomorrow? But systems aren't just about what you do. They're about how much you risk when you do it. The math of position sizing is where process becomes measurable, where fuzzy concepts become hard numbers. Chapter 6. Position Sizing, the Discipline Mathematics. 2 traders, same strategy, same trades. One made $100K, one went broke. The only difference? Position sizing. Position sizing is process expressed as math. It's the difference between gambling and trading. While everyone obsesses over entry signals, professionals obsess over position size. Because in the financial desert, it's not about finding water. It's about rationing what you have. The Turtle Traders Experiment, 1983. Richard Dennis bets he can teach anyone to trade. Recruits 23 novices, gives them identical rules. Jerry Parker follows the position sizing formula religiously. Risk 2% per trade, scale into winners, cut losers fast. Another turtle, let's call him Mike, thinks he's smarter. Same signals, but he goes bigger. Why risk 2% when the setup is perfect? I'll risk 5%. First month, both catch the same trends. Parker makes 12%, Mike makes 30%. Mike's feeling genius. Month 2, silver crashes. Both have stops at -2 ATR. Parker loses 2%, Mike loses 5%. Month 3, another loss. Parker down 2%, Mike down 5%. Month 6, Parker is up 23% for the year. Mike blew out, same exact trades, different position sizes. Fast forward, Jerry Parker now manages $1 billion. Mike, nobody remembers his last name. Ed Seykota puts it perfectly. The key to long-term survival and prosperity has a lot to do with the money management techniques incorporated into the technical system. Look at the Kelly criterion.